Thank you for joining us today. We at Sendero welcome the opportunity to speak with you at this time of the year about what we see in terms of the outlook for 2026. And we're very fortunate today to have Anne-Marie Conti, who's Director of Research at Sendero, here to talk a little bit about what our direct market expectations are. Importantly, we have two of our advisory board members with us today, Patrick Kennery and Thano Hasiotis. And they will speak more specifically about macro conditions and then equity market opportunities and conditions specifically. We'll follow up this webinar with two more webinars in the near future. One that will focus more on what worked from an asset allocation standpoint last year and how this outlook that we have fits into our ongoing outlook for 2026. And then one with our Director of Due Diligence, Rodrigo Lopez, who will speak more specifically about what some of the specific equity opportunities were that worked in the past year and how we're set up for 2026. So at this juncture, let me turn to Anne-Marie and just review what our annual forecast is that we put out with a bull and bear scenario for 2026 for both equity markets and for fixed income markets. Anne-Marie.
Yeah, thanks, John. And most of our viewers may not realize this, but this is the 8th year that we've been doing the bull bear. It really started back in 2019, or actually 2018, to answer a simple question. It's like, what do you think the market is going to do? And it's turned really into a robust and disciplined process that kind of really fits within our asset allocation framework. And to that point, the way we think about it is a base case, a bull case, and a bear case. And we adjust and assign some probabilities as well as ranges to the S&P 500. So when we look at our base case for 2026, as a reminder, the S&P 500 closed the month of December at 6,845. Our base range for most of 2026 is between 7,000 and 7,200, which doesn't sound like much, but it's about a 6% total return. And really that is a continuation, as will be discussed by Thano and Patrick, of continuation of the overall economic growth that we're seeing, and most importantly, about expectations of about a 13% year over year of S&P 500 earnings. When we look at our bear case, obviously a growth shock with the higher probabilities of even more geopolitical tensions than what we've seen so far, along with a disappointment in earnings, will take us down to about 5,800, 6,000 on the S&P, which, to put that in perspective, would take us back to kind of the April-May timeframe of last year. On the bullish case, when we look at not just earnings continuation for AI, but a broadening across other sectors with potentially some Fed cuts or more Fed cuts that are currently priced, our bull case has a range of about 75 to 7,800 on the S&P 500, which is about 15%. So that gives you a kind of sense of what we're looking at for 2026.
Thank you. That's helpful. What about in the fixed income markets, specifically the 10-year, which is probably what we spend more time looking at than anything?
That's correct. And actually, when we look at our 2025 forecast, we were actually better predictors of where the 10-year actually ended up, which was really a range between 4 and 4.5. And for the majority of 2026, we expect a continuation of that trend. Now, we could see, obviously, if we were to see some kind of risk off or some more deflationary type of pressures, a big move in the short end and the long end, which would take the 10-year down below 4%. Conversely, we could see a big move in the 10-year in a steepening of the curve that potentially could take us back to 5%.
Thank you. Let me shift gears from the bull bear, and I'll just introduce very briefly Patrick Kennery to our audience. Patrick had joined us in about 2018 as a advisor to Sendero. And prior to that, Patrick and I had worked together probably 20 years ago at one point, and then he left the firm I was with and joined a West Coast-based investor by the name of Peter Thiel, and ultimately became his chief investment officer on the macro side of things. So we're very fortunate to have Patrick to be able to share his views of the macro situation and how the economy is set up at this juncture. So Patrick, I'll turn it over to you to talk about what the major themes are you see from a macro perspective.
Thanks, John. The major themes are, it's almost like a non-theme in the sense that for those who have listened to prior webcasts that we've done, our position has been that inflation is, or risks of inflation or concern about inflation were probably overdone, and that the combination of policies coming out of the federal government, both immigration, restriction, trade, and some of the movements in the budget are actually counteracting some of the forces that people were concerned about with inflation. In fact, in some senses, those are probably negative for inflation. And this is important for investors because this cycle that we went through that really probably, you could say, started with COVID, which was a big deflationary shock, followed by massive stimulus that in both monetary and fiscally, that became an inflationary shock that then had to be tamped down with Fed policy, had left investors somewhat shell-shocked and uncertain, for several years. And it appears that we're emerging from that into a more benign environment where we have kind of cut off the tail on the inflation side. And while inflation still could reemerge, it's just not only does it appear to be much less likely just based on the fundamental factors, but if you look at how the market is pricing option volatility across interest rates, equities, and foreign exchange, it seems to be saying that there's a narrower range of outcomes than what we've seen in the past several years. So that makes the overall environment more benign. It's not necessarily table pounding bullish. It just is kind of narrowing the bounds of the risks. One of the other themes, because I know for most people who've been following the stock market, this has been something people have watched, is it has been a fairly narrow rally really up until the fourth quarter of 2025. And it was led by the Magnificent Seven, the major big tech stocks. That tended to be a huge proportion of not only stock market gains, but also the market cap of the indices themselves. The indices are cap weighted, and the top 7 or 8 stocks, whichever ones you want to include in the big tech stocks, were up 40 to 50% of the overall index. And that is something that, that is a trend that went on. It takes a long time to get to that point. And historically, and I think it's always prudent for people, to respect when there's a trend, to not simply say, oh, this has gone on too long, and so it just can't go on anymore. But if there is some sort of catalyst that can cause the trend to shift or stall out or even reverse, then it's worth paying attention to. And arguably, the very thing that has brought a lot of the enthusiasm about big tech is also something that could cause the trend to stall out, which is artificial intelligence, AI investment. And AI investment, the reason why that's important is not because it's necessarily a bad bet or it's not going to work out, but it changes the business model of these companies. If you look at these same companies, let's set aside NVIDIA for a minute, but the major investors in AI, If you look at the companies that they were 10 years ago, they were essentially monopolies in their respective businesses. They had huge margins, and part of what a monopoly does is it tends to restrict output. So it's not forced to invest as much in order to compete. And so what they did instead of investing is they accumulated huge cash flows, which a lot of got returned to investors in the form of stock buybacks, in some cases dividends. And that model that made them extremely safe and caused them to trade at very high multiples, there's a little bit of muscle memory to that today, where people are still valuing them in those terms, but their capital expenditures are multiples of what they were in the past for the AI. And so on the side of large tech, again, it doesn't mean that it's not going to work out and there aren't going to be big winners, but it does make it riskier because CapEx is riskier than buying back stock or paying dividends. On the flip side is that CapEx, if you just think about it mechanically, it goes to other entities, to either companies or workers or people who own the properties that they have leases on. And so that money is being spread out into the larger economy, into other and wider sectors of the economy and the S&P for that matter. So the other 493 stocks, many of them are getting revenue either directly or indirectly from this big investment boom that we've seen. And just to give you an idea, the scale of the investment boom for AI is something on the order of 1% of GDP this year. And so it's a very large number. And it's making large cap somewhat riskier relative to their past sort of business model. And at the same time, it's driving economic activity and revenue into the rest of the economy and the rest of the S&P. And finally, sort of a related aspect of the potential rotation is part of the dominance of the US markets relative to global markets for the last decade or so has been because of the sector makeup of the US. The US tech companies are uniquely American, and some other sectors like pharmaceuticals and things which tend to have similar dynamics in terms of huge cash flows and large intellectual property. Those are dominant in the US market in terms of its market cap, where the rest of the world is more weighted to cyclical financial type stocks. So if there is going to be a rotation, if it's global, it tends to favor, because of the composition of other countries' stock indexes, it tends to favor those indices more than the US. And so that is an argument for maybe becoming more neutral on the US relative to the world versus being overweight as we've been in the past.
Thank you, Patrick. That was most illuminating. Let me introduce our next guest, and that's Thano Hasiotis, who is a member of our advisory board as well. We've had a long history with Thano. He started out on Wall Street as an equity analyst, became a transportation and industrial analyst, and then ultimately moved on to working at a hedge fund that Sendero invested in for years called Carlson Capital, and ran their industrials team, which was one of the most successful groups within that organization. So Thano is a much more traditional stock picker. And so we felt he has a particular view to looking and thinking about how the equity markets are set up and where opportunity exists and where some of the risks are. So at this juncture, let me turn it over and introduce Thano Hasiotis.
Thanks, John. So just to recap, broadly speaking, the outlook for U.S. equities is good. You've got a positive outlook for corporate earnings. You have deregulation efforts by the administration really beginning to kick in 2026. And you have a backdrop where the Fed is likely to cut at least 2 times, which always helps stocks in the U.S., if not 3 or 4. As Patrick mentioned, inflation seems to be nipped in the bud. If it stays in the mid 2s or upper 2s, it doesn't seem to be an issue that's going to disrupt the Fed on its path of lower rates. In addition to that, The jobs numbers, particularly if you take out healthcare for 2025, are fairly weak. So I think that's going to keep the Fed biased to cutting. And when you have a bias to cutting and a positive outlook for earnings, it usually spells a pretty good outlook for U.S. equities. So what sectors inside of U.S. equities, broadly speaking, do I see that, look good to me? I think that in technology, there will still be select names that work. I don't think you can own everything in technology, but it's definitely more of a stock picker's market. Some of the process that Patrick mentioned about spreading money out and spending it, the market has already sniffed that out and started that trend last year. I think that will continue. So the other sector that I think looks really good will be industrials, and whether those are people that actually participate in the building of these, the hyperscalers, data centers, or it's building power generation, or it participates in the reindustrialization of both the United States and North America. This just looks like a very good time for those names. Also, financials had a good year last year. I think that continues. That's based both on, again, the spending by the hyperscalers. That's just sort of generates, there's a lot of debt revenue, there's a lot of deal making that improves the fees of the investment banks, and then also the financing of all the industrial activity that would happen around AI. Finally, there are a couple of sort of shorter term, next sort of 6 to 12 month sectors that are probably going to find some relief. One would be retail. We're going to go into the tax season this year, and a lot of middle class Americans are going to see some better taxes from the no tax on tips. That usually finds its way into consumer stocks or their performance. Also, if the Supreme Court overturns tariffs and the administration puts them back on, it's likely that they don't put them back on to the same degree, or there's more holes in them, and that would provide some kind of short-term relief. Again, this is short-term for some of those retail names. And remember, as much as we're trying to reindustrialize the U.S. economy, we're still largely a consumer-based economy of close to 70%. Finally, the last two sectors are transports. They tend to lead the economy. They've sort of underperformed for the last 2 years. Those are breaking out. And also biotechnology, which has been in a rut on a stock basis for 5 years, finally broke out in the second half of 2025. And that looks like, just some of the cycle of creating some new therapies and things like that look good, as well as the application possibly of AI. And overlaying all of this, we have had a productivity boom in the United States really for 20 years with the application of technology. I think we have done it better than developed countries, whether it's in the Asia Pacific region or Europe, which is one of the reasons why the U.S. stock market has performed better. We've averaged about 1.4% on productivity, which is really fantastic. The question is, and this is just a question of how bullish you want to be, is does AI add another 1% or 1.5% on top of that? I think AI adoption probably comes slower than people think, but even if you were to just add 50 basis points to the 1.4, we approach 2% productivity. That is a very, very positive backdrop for stocks.
Because that all translates into earnings as well, so, and
Earnings.
and margin
Earnings.
expansion.
Margin expansion, earnings without inflation, and multiple expansion.
So a pretty attractive backdrop, actually. So I'm going to put the caveat out there in our conclusion is anybody who's seen me with forecasts knows that I always remind people of the advice I was given when from a partner at Goldman when I took a job where I was going to forecast. He just told me, just do it frequently, John. And so that caveat is always there in terms of forecast. The other thing I think that we do have to recognize is that we are in an environment, and we have been in an environment where there's a lot more noise. And what do I mean by that? There's a lot of mixed signals that come into play. we're really trying to identify what we think are long-term themes and long-term opportunities, and trying to build portfolios that we think will be resilient in the long run to even that noise that we get. So at that, we wish everybody a very happy new year, and we look forward to another prosperous year. Thank you.